Hi, this is Jim. Assuming you have watched Part 1, Intro to IUL, you should have a basic understanding of IUL. In this video, I will give you a simplified overview of why maximum funding of an IUL is important for cash accumulation. The majority of life insurance policies are issued with the desired death benefit determining what the premium is. Whole life policies call this the book premium, and for IUL, this is called target premium. When using standard funding, expenses might be around 2 to 4%, which pays for mortality and administration charges. Policy expenses, of course, will vary depending on the company and the product, but the IRS allows you to put in more excess cash over the standard amount, which goes directly into your cash value to increase accumulation. With this additional funding, the expenses can go down to maybe even 1% or less. Think of base policy charges like using an ATM machine. If you have a transaction fee of $3 and you take out $60, you just paid a 5% fee. But if you take out $300, your fee now becomes 1%. You're just reversing the concept. The 1% expense of an IUL is comparable to fees charged by a money manager. But this is a life insurance policy, so the 1% pays for protection. You will always have a death benefit in addition to your cash account, and with the accelerated benefits feature, you can access your death benefit if you have a serious illness or injury. So now you have living benefits. Let's say over the next 5 years, you plan to put $100,000 into an IUL for future retirement income. Design A uses the target death benefit of $2 million. Design B uses the IRS minimum required death benefit of only $500,000. With Design A, the $2 million death benefit charges drain a high portion of the money, whereas when you use a lower death benefit with Design B, the mortality charges are much less, leaving more money in your policy. Since your focus is on cash accumulation, not the death benefit, Design B is best to maximize your cash to grow tax-free. But how much money can you put into a policy? In response to the introduction of flexible premium universal life, in 1982, Congress defined a required amount of death benefit that must be purchased above the cash value balance for the policy to qualify for the tax advantages of life insurance. This is a formula for the ratio of required risk or death benefit to the cash at any given age. The younger the age, the higher the multiple, and as you age, less is required. In the 2020 HEROES Act, Congress updated the tax code. The ratio of required death benefit to cash decreased the amount of risk required to qualify as a life insurance policy. Less death benefit required means less mortality expense. Now you can have even more cash in your policy. This update was a big win for consumers. It is important to stay within the guidelines, so earnings within the contract will accumulate tax-free, which is tax code 72E. You can access the funds tax-free through policy loans. This is tax code 7702, and proceeds have always been income tax-free to beneficiaries, tax code 101A. If you follow the funding guidelines, you can create a liquid asset that continue to grow for each generation free of income tax. Some call this a private family bank, and there's many names for this strategy. Putting in the most cash with the lowest death benefit is the first and primary design step to maximize cash accumulation. I will discuss other design features and things you can do to help cash accumulation in other videos.